All right, guys, let's talk about loan modifications. And so this is a really important topic if you are dealing in whether you are dealing with people facing foreclosures or if you are dealing in the creative world, like in a subject to matter. So the reason this is important, it's good for you to understand in general, but let's kind of break this down. I think that this is one of those topics that doesn't get talked about a lot, and it's technical. So I want to share with you. Uh, this is something as someone who stopped foreclosures for the last 10 years and who has done creative financing like Subject to, this is something that I frequently come across. And so a lot of this information has been learned. I am not a lender, not pretending to be one on YouTube or other places. So understand, I both reference some technical terms here, some just to make sure I'm sharing it correctly, but it's mostly going to be coming from experience as well. So maybe you've heard the word loan modification before. And so it is exactly like it sounds, which is it is a modification to the loan. But generally, this happens because of some sort of hardship, and it's being done to prevent foreclosure. So when a homeowner gets behind on their payments, people don't realize that basically the lender's hands are tied legally, for pursuing the foreclosure process until a certain time. Meaning, basically, let's just say you miss your first payment. Now the lender has to wait. They have to wait until a certain amount of missed payments before they can actually start the foreclosure process. And so during that time, the lender is going to be reaching out to the borrower and saying, "Hey, here are some options. Hey, you already qualify for XYZ." Trying to resolve the issue before it gets to that legal matter. They have an entire department. It is called the loss mitigation department. And so, when folks start getting delinquent on their loan, someone in the mitigation department usually reaches out. So they'll receive phone calls, emails, and even mail discussing some of their options. So let's talk through one of the most common options that are given is what's called a loan modification. So let's just say your monthly payment is $2,000 a month. Okay. If you're behind 3 months, so that's going to be more than $6,000 because you've got the 2,000 three times, plus you've got those. And so, whatever that comes out to be. Okay. So over $6,000. When someone is struggling to make a $2,000 a month payment, they will often struggle to do that 6,000 all at once as well. And so a lot of times the lender will say, "Hey, here are some options." And one of them could be a loan modification. Now, granted, maybe they're behind 3 months and that's 6,000. But I just spoke to a woman, not yesterday, 2 days ago, who's behind 12 months and hers is 21,000. Okay. So, and especially the further along it gets, a lot of lenders say, "We're not willing to take a partial payment. We only want the full lump sum." Each lender is different in their requirements. And a lot of times it's also based on the situation as well. So, um, with that being said, a loan modification is an agreement to modify the loan. Now, it can look like a lot of things. There has to be hardship, and it's got to be, they're not just going to call you out of the blue and say, "You know what, you have an 8% interest rate. Let's just go ahead and, today we're feeling generous. Let's just lower it." No, this has got to be to prevent a foreclosure because of some sort of hardship, something like that. So when a borrower is struggling to make the payments due to some sort of issue, job loss, illness, something like that. So now, again, this will vary by lender, but here are some of the ways that a loan can be modified. So let's just say someone has a 30-year loan, and maybe there's, 27 years left on it, right? So they've been paying on it for 3 years. And let's just say it is an 8% interest rate. Okay. Now, with that being said, let's just say, the borrower is struggling to make payments. Some of the ways that and they're behind the 6,000. Here are some of the ways that the loan can be modified. So the first one is they could they could lower the interest rate. Now it could be lowered for a small amount of time. It could be lowered for the rest of the life of the loan. I do not see this one as often. I'll be very honest. I do not see this one as often. And so just know that it can happen. They can say, okay, hey, like for example, um, they can say, okay, instead of it being 27 years, let's go ahead and just push it to 30 years and makes the payment. So when you spread, think about when you get a 30-year loan versus 15. 15 is, you got a lot shorter time to pay it off. So that payment's a lot higher. So what they'll do is they'll extend the term of the loan to make that monthly payment go down, to make it more affordable. Um, one of the most common ones is that they will take that 6,000 and throw it on the back of the loan. It is still due, just not due today. And so then they're no longer in default. They'll generally sign a loan modification agreement. It oftentimes gets recorded in public records. Sometimes it does not. I have come across that. And it is a situation where they are still obligated to pay that. The lender then agrees that, hey, we'll put those arrears, those missed payments on the back of the loan. And you'll go ahead, you're now caught up, and but they're generally going to want to make sure, they're generally going to want to make sure that this is a good fit for both parties. Okay. And every now and then I've seen where, or I've heard of where they'll take an adjustable and turn it to fixed. I've not seen that myself. So let's just say, okay, how do they know if this is a good fit? So good question. So I have seen two versions. I have seen what's called a no-doc loan modification, which is we just need you to make, today's April 1st. We need you to make April's payment. If you make April's payment, then we'll go ahead and we will approve this loan modification. It is an application. Let's be very clear. It is not guaranteed. There is, generally it is an application. There has to be a level of like approval. It is not an automatic, you just go click and make it happen. The lender has to assess it and decide if that's the right fit. And so the no doc one has often been, hey, if you can make the next payment, and let's just say you make 2 payments in a row, then we will approve this loan modification. Like basically, I've seen that most commonly where someone got behind, the borrower died, the borrower is deceased, the heirs come into the picture, it's a few payments behind, and they're like, hey, we will catch up, we can't catch up the loan, but we can make the payments. And so I have seen it in that situation where it was a no doc loan modification, meaning they did not have to send their financials or anything like that, because the other one is documentation. It is a literal application similar to a loan, your pay stubs, your W-2, your tax returns. They might even look to see at your bank statements, because at the end of the day, they want to see, they want to basically qualify you. Can you handle making these payments? If we're going to go through all of this effort, can you even like rectify this situation and get out of hot water? So with a loan modification, again, remember, it is not guaranteed. And it does change the nature of your loan. Every lender, what they are offering, again, it's different per lender, it's different per situation. And understand this. I had a seller one time who had done 2 modifications throughout the life of the loan. Maybe one of them 8 years ago, one of them 4 years ago, and then they had done one just last year, a third one, and then they were trying to do another one, and the lender just said, you can't afford this loan, or whatever the situation. The lender just cut them off. They just said, you know what, too many loan modifications on this same loan. So it's not like the other ones were passed with a different loan in the past. It was all the same loan, and eventually they just said they declined them. And you can appeal a decline, but oftentimes the lender has the authority to say yes or say no. So why is this important? Loan modifications. So many of these loan modifications has happened. Again, it's a deterrent to a foreclosure. And this is one of the ways I believe that, we got through COVID relatively unscathed with foreclosures to a degree, because so many of these loan modifications were happening during that time. Guys, it is so common. And what's really important, one of the most common loan modifications I've seen is what's called a partial claim second. I'm actually going to do an entire separate video on that one because I think that this is really important. Is that a partial claim second is where the first mortgage, let's just say you are behind, $10,000. They will take that $10,000, put it into a second mortgage on the property with no payments due, 0% interest due decades later, basically at the same maturity date as that first. So, if that first is due, roughly in 30 years, give or take a few years, right? Then whatever the maturity date is on that one, the due date, and then that's going to be the same on the partial claim second. This is most commonly done by HUD on FHA loans. And so this is super important. This is how I believe the government has bailed out a lot of homeowners and lenders to avoid a major financial situation with like a wave of foreclosures with, the pandemic and everything. So I'm going to break that down in my next video. But guys, this is super important to understand, especially when you're dealing with someone in foreclosure. A lot of times people, they'll consider this, but if they do a loan modification, one of the biggest things when I'm buying a property subject to is that I want to look and see, hey, have you ever made changes to your loan? If people facing foreclosure have often, it's not their first time. Sometimes it is. Granted, a portion of the time it is, but a lot of times it's not their first time. It is where they have maybe they've gotten behind in the past and then they got caught up and then another issue happened, right? So truly, this is an opportunity where I want you to make sure when you are looking to buy a property. So for example, if I'm looking to buy a property subject to, number one, I do not help homeowners get loan modifications, okay? I'm not going to help them fill out the application. I am actually very hesitant to take a property subject to with a very recent loan modification. Now, I have taken them subject to with an older loan modification that they've done, at least, a year ago or more. But if it's been less than a year, I'm a little hesitant. And because one of the biggest things is, depending on the loan modification, it actually may have language that says that the owner has to live in the property. There may be some um, guarantees that the owner made. I want to see, what's the nature of that loan modification. They're not all the same. They're not, um, yeah, they're not all the same. And at the same time, they're not all, it, hmm, I'll say it this way, that every situation it's going to bend. But I am not helping a loan homeowner do a loan modification at all. I am not stepping in that position. I may say, hey, talk to your loan your loss mitigation caseworker and discuss that option and look it over if it's the right fit for them. I see a lot of investors doing loan modifications for sellers, just so that 20,000 they're behind gets, added back to the arrears or something, because they don't want to go ahead and do, you know, uh, basically bring that to the table for a subject to. Red flag, red flag, red flag. Look, when they're doing loan modifications, a lot of times they are going to run title. They are going to secure that loan modification against title. Um, you know, basically because it changes, especially when it changes the nature of the agreement or, anything along those lines. You want to be very mindful. I never want to pretend to be an attorney for someone or, helping them, fill out forms or anything like that. So you want to be very, very careful with stuff along those lines. Guys, loan modifications are very much a real reality in this world. You want to be mindful, you want to be careful. And you just want to understand they exist. You want to understand them for yourself if you ever find yourself in a hard position, but this is more, this is most people, it's going to be understanding this, that when you are analyzing deals, understand that loan modifications exist and that they are very much popping up. And owners oftentimes do not understand, they do not understand what they agreed to. They just know it got them out of hot water. And so that's something where you want to be able to understand it so that you can navigate it when you are dealing with the seller. Guys, thanks for tuning in. And guys, we're nearing the end of 100 videos for 2025. So hope you guys have been enjoying these. Appreciate you guys. All right. Check out the partial claim second video that's going to be coming after this.